President Trump says he's firing a Fed governor, but how will that go down with the markets? President Donald Trump said late on Monday that he's firing Federal Reserve Governor Lisa Cook over alleged improprieties in a mortgage she got before she joined the Fed, in a step that could test how much power the president has over the central bank. Cook says he has no authority to remove her and she'll carry on in the job. A potential legal case could go all the way to the Supreme Court. Elliot Hentov is head of macro policy research at State Street. Elliot, does the president have the power to remove Fed governors?
You could ask a lawyer, but I'm here to think about how the market will perceive it. And what I can tell you is it doesn't really matter whether he manages to fire Ms. Cook or not. What matters is the trend of travel, and the trend of travel is that the classic conception of what Fed independence is over. In some shape or form, the Fed will come under increased control and influence of the White House, and markets have to price that in some shape.
We've already seen a slide in the dollar and in longer-dated treasuries. How are you expecting the market to move from here?
I still think we're in the early days of that direction of travel. I think long-term yields have already not moved in line with where the short-term cycle is going. Markets have clearly priced in a rate cut in September, but long-term yields have not budged. And I think that is the beginning of the pattern that we should expect over the next 12 to 18 months, which is that long-term yields remain incredibly sticky and may even reflect some upward pressure as worries over Fed independence and worries over inflation management over the medium and long term crystallize even further. So higher for longer is basically my message here on long-term yields.
What might we see in the markets if this becomes a drawn-out legal argument? Will we see a steeper reaction in US yields?
The question is really, I want to be very sober here. There is a credible argument to be made to say, hey, wouldn't it be better if monetary and fiscal authorities coordinated policy more tightly? That's very different from saying the central bank should be submit to the will of the government and the executive. And I think the market is still testing out, is this just a story of a little bit more closer coordination, or is this a story of where basically the independence, i.e. the ability to manage inflation independently, whether that gets eroded? I tend to think it's going to be more the latter over time.
You mean you think investors haven't taken that threat seriously enough yet?
Yes, that's precisely what I think. I do think inflation expectations are going to move up higher, long-term inflation expectations, and you will have a much steeper yield curve in the US dollar zone in the coming year and a half.
What does that mean for US government borrowing, which is, of course, already at a historically high level, if investors start to look at the US central bank as something that is coming under government control?
That's one of the problems that is going to arise, which is that it's very hard for the US government to finance long-term bonds because rates are not coming down. If at all, if I'm correct, they will stay high and go higher, which means that the only option the government then has is to finance with shorter term financing, which they've been doing over the last 3 years, shorter and shorter, more and more treasury bills and short-term debt at the expense of long-term debt. So the average maturity is coming down and down. And that's okay in the short term because you're paying a little bit less on short-term interest. If you think about where the 2-year is, it's about 3.75%. The problem, though, is the more you have this short-term debt, the more you have to roll over constantly, and the more you have interest rate risk on your balance sheet. And basically what I'm trying to say is the economy and via the government debt becomes much more fragile and exposed to short-term fluctuations in interest rates. And so that's going to be another point of vulnerability or fragility in the future.
How do you hedge then against the uncertainty under the Trump administration? We've seen a rise in gold today. Are investors going to turn back to those traditional hedges?
That's clearly one that has worked phenomenally well over the past year. Some have talked about the digital equivalents. But what I think really is interesting is the split between how U.S. and non-U.S. investors are looking at that. So we see in the behavior of U.S. investors a lot more fear about the debasement of the currency and the rise in inflation. And basically, U.S. investors have change their hedging behavior on foreign assets and change some of the capital allocation to have more non-dollar assets in their portfolio. We see less of that reaction among foreign investors, and one could basically speculate, well, basically foreigners are saying, yes, the dollar has all these issues, but that's more than offset by the fact that U.S. equities are just such a great investment. They're priced in dollars, but these are companies that are very strong, deliver higher earnings growth, and therefore the price rise outweighs concerns over the dollar debasement.
But where do you think those fears might lead the US economy in the longer run?
Well, as I mentioned, on the government end, there's increased fragility around government financing. And so that means there's a huge reliance on the private sector and the growth engines of the economy to continue to power ahead. And so we just the US becomes a much more reliant on continued success, particularly of its leading industries like the tech sector. If those start to sputter, then you can basically have a much faster downfall or downturn in the US economy.
That was Elliot Hentov of State Street. Don't forget, you can watch more videos on Reuters.com.